In 2020 and 2021, people locked in at ultra low interest rates. Then the Bank of Canada raised rates at the fastest pace in history. And now in 2025, they've started cutting again, which brings us to a big question. Should you go fixed or should you go variable? If you're buying, renewing, or refinancing this year, this decision could make or break your household budget. We're talking thousands, sometimes tens of thousands of dollars are on the line. That's why in this video, we're going to break it all down. I'll show you the numbers, we'll dig into the risks, and I'll expose the traps the banks don't want you to know about. By the end, you'll have a clear framework to decide what's right for you. Now, here's why this matters. Most Canadians don't hold 5-year mortgages for the full 5 years. The real average is 3 years and 6 months. That means penalties and flexibilities matters just as much as the rate. And let's be honest, this isn't just a numbers game. It's about peace of mind. It's about whether your household can sleep at night knowing your payments would suddenly spike. And that's what's on the line. So let's get into the confrontation. Fixed versus variable rates this year. All right, now that we've set the stage, let's dig into the battle. Fixed versus variable in 2025. This is where we peel back the layers. Bond yields, the Bank of Canada cuts, product structure, and yes, those hidden traps that have burned a lot of Canadians in the last cycle. So here's what we're seeing today. 5-year fix is sitting somewhere in around 4.5%. A variable, once prime adjust, is about 5.5%. That's $140 a month difference on a $500,000 mortgage. Over 5 years, that's more than $12,000. So why would anyone choose variable? Because if rates cuts keep coming, variable can quickly overtake fixed. Now, fixed rates are tied to the bond yields, not the Bank of Canada directly. When the 5-year Government of Canada bond goes up, fixed rates follow. When it drops, fixed rates come down. And here's the curveball. For much of the past years, the yield curve was inverted. That meant short-term bonds were actually more expensive than the 5-year bonds. That's a recession signal. In 2025, the curve is normalizing again. That tells us markets believe rates will settle in lower, but not without volatility. Now, variable rate mortgages are tied directly to the Bank of Canada's overnight rate. When the bank cuts, variable borrowers feel almost immediately. Historically, variables beat the fix by about 80% of the time. But history isn't everything. The bank cuts to stimulate the economy. The stimulation can spark inflation. And when inflation comes back, the bank raises rates again. That's exactly what happened in the late 70s and 80s. People thought the worst was over, locked into cheaper debt, only to watch rates soar again. So the gamble is this. Do you believe that rates will continue to fall enough and for long enough to offset the risk of them spiking again? And can your household handle if you're wrong? That's where risk tolerance comes in. I always ask clients, what is the worst case scenario? If rates went up to 2% tomorrow, could you handle it? Could you still cover your sports for your kids, groceries, savings, or would it break your budget? If you can't stomach the swings, variable might not be the right fit for you, no matter how attractive it may look on paper, because a mortgage isn't just math, it's your home, your family, and your peace of mind. Now let's talk about the trap that shocked many people, adjustable versus static variable rates. Adjustable means that your payment will move with rates. It goes up and it goes down. You always know where you stand. Static means that your payment stays the same. And now that sounds safe, but here's the problem. If rates rise again, more of your payment goes to the interest. At a certain point, the trigger rate, you're no longer paying principal. And suddenly the bank calls, they tell you increase your payment or make a lump sum payment, or will convert your mortgage into a fixed product. That's what blindsided thousands of Canadians at the big bank. Adjustable payments avoid that mess. Now, let's say that you go variable today expecting cuts. 6 months later, rates are lower. You think, now it's time to lock in. But if you're with a big bank, you don't get the market rates. You get the bank's internal rates, and those can be significantly higher. With monoline lenders, you lock in at the best available rates. That's flexibility. Now let's talk penalties. If you break a big bank fixed, you're facing their interest rate differential, and those penalties are inflated with hidden discounts. I've seen $400,000 mortgages with penalties over $20,000. With a monoline lender, the same break might cost a quarter of that. That's why I tell clients don't just shop the rate, shop the penalty. So, who actually wins with fixed? If you're risk adverse or maxed out on your budget, a shorter fixed term, 2 or 3 years, can make sense for you. It gives you stability and a chance to reset when rates may be lower. So, who wins with variable? People with stable income, savings, and margin in their budget. People who can keep paying the higher amount even when rates fall, hammering down principal faster. But remember, the real enemy isn't fixed versus variable, it's bad products. Big bank traps like static payments, inflated penalties, and restrictive lock-ins. That's what costs people the most. So how do you make the decision? Stress test yourself. What if rates go up 2%? What if they drop 2%? How would you react? Those answers reveal whether you're built for fixed or variable. And if you're still unsure, there is even a hybrid strategy, splitting half fixed and half variable. Not perfect, but a good compromise for the indecisive. So where are we? Right now, fixed is slightly cheaper. Variable could win if rate cuts continue. The real decision comes down to the risk tolerance and flexibility. Okay, so we've looked at the history, the numbers, and the traps. Now it's time to bring this all home. Because the truth is, there isn't a single right answer for everyone. There's only the right answer for you. Here's my decision tree. Step 1, how important is stability? Step number 2, what's your time horizon? And step number 3, if you go variable, are you choosing the right product? This isn't just a Bay Street debate. This is across different municipalities all across Ontario. Families here are stretched between hockey fees, dance lessons, grocery. It's real life. That's why you can't just follow the headlines. You've got to run your own numbers. Flexibility beats predictions. Economists get it wrong all the time. But if your mortgage gives you flexibility, low penalties, fair, aggressive prepay, you can adapt. So where does this leave us? Fixed is slightly cheaper today. Variable could take the lead as more rate cuts continue. The real decision comes down to risk tolerance, flexibility, and lender product design. If you're wondering which path fits your situation, that's what I do. Book a 15-minute call with me. The link is in the description, and I'll run your numbers and make sure that you're not leaving money on the table. And while you're down there, please hit the like button, subscribe, and check out the calculator that's linked in the description. It's packed with tools, and it makes these decisions way easier. Fixed or variable in 2025 isn't about guessing the future. It's about setting yourself up to adapt, to save, and to win no matter what happens. I'm Justin Chausse, your mortgage expert. Thanks for watching, and I'll see you in the next video.